Hey everyone, Grant here, and today we're going to be taking a look at whether or not stock splits are good or bad. It seems to be kind of a popular question for people to ask, so we're going to try and tackle it here. We've got a few different resources we're going to try and lean into. So, we'll just jump right into it. So, first off, what is a stock split? A stock split is when you take a stock, you've got an existing number of stocks that a company has issued, and you either increase the number of stocks or you decrease the number of stocks depending on whether it's a forward or a reverse. So forward means you're going to increase the number of stocks, reverse means you're going to decrease the number of stocks you're going in reverse. So basically, people have different opinions. We've got a few different resources here, but here's one breakdown. We've got cfajournal.org. They seem to think that there's a few different benefits and drawbacks to having a stock split. Stock split decreases the share price, and it makes it an attractive decision for retail investors. That means, people who typically aren't, that's not their whole life. They're just purchasing it like they'd buy something at Walmart, essentially. So, and I would agree with that. That is definitely something that, people who don't have a lot of experience with stocks probably aren't going to drop a whole lot of money unless they know what they're doing. So, having a shares or a stock split, it's a good way to get people who aren't already investing a little bit more interested in investing. So, increasing the share trading, increased share trading increases the company's liquidity. I brought up the definition of liquidity here just so that we can kind of have a similar understanding of what they're talking about. Liquidity refers to the efficiency or ease of which an asset or security can be converted into cash. So basically, they're saying that by having a stock split, the company, it's easier for you to take your stock in the company and turn it into cash if you need to sell your position. And I would agree with that. Total market capitalization remains unaffected. That's true. You don't have to worry about the price of something jumping dramatically up or down if the stock split's going to come. Usually stays pretty consistent in terms of the cost. It's just that now with more or less shares, the pool's a little bit more or less diluted, and that'll just change how much it sells for. Shareholders keep their percentage value, and there's no tax implications. That's true. What that means essentially, if somebody owns 10% of a company, if there's a stock split, they'll change the value of, or the value will change based off of how many stocks there will be after the split. So if they reduce the number of stocks, they keep that 10%, essentially. Stock market analysts and rating agencies take the decision as a positive signal, and it further strengthens the share price. So people typically think that if a company is going to have a stock split, it means that more people are going to be interested in it, more people are going to want to buy the stock. That means that there's going to be maybe even a little bit of buzz around it. With more people interested in wanting to have ownership in that company, it means that it's going to be potentially a strong position moving forward, and the price might go up as a result. Something that I wouldn't say is guaranteed to happen, but you never know. So, and then the drawbacks. Stock split is not a permanent solution for excessive share prices. So, companies like Microsoft have had as many as 9 stock splits since the IPO or initial public offering. That's true. If you have a company and it does well and people are really interested in it, they might keep buying the stock. And again, with things like inflation, you're looking at a long time horizon of owning a stock. There's a chance that it's going to be a lot more expensive down the road, and that's where you might end up with a company like this where you're looking at 9 different stock splits before you eventually sell your position. Only tax implications for shareholders is on capital gains. Increased shares may increase the tax burden. Just having more shares isn't going to increase your tax burden, but again, going back to this number 5, if more people are interested in a stock, that kind of helps drive the share price up, and that's essentially what capital gains comes from, is a share price being higher than when you purchased it. So it's not a direct factor, but it's definitely something that I guess if you're really against the idea of having to pay capital gains or have taxes because you have capital gains, it's probably something that maybe investing in stock isn't something that's for you. But and then the last point that they've got here: shareholders may not be able to sell the additional shares quickly, as any covenant may be attached with the stock split. I guess I'd have to do a little bit more research to understand what specifically they're talking about here. I'm guessing this must be some sort of a contract that is involved with purchasing those stocks. When you've got an agreement, you've got a contract, you have to basically live up to it, otherwise there's going to be penalties. I guess in certain circumstances it might have to do with selling too soon as far as a stock goes and after a split. So, all right, we'll take a look at another resource here. This is Bloomberg. They seem to think that having a stock split is a good thing. We'll just kind of browse through this article to see if we find anything that catches our eye. So this kind of talks about the math behind what a stock split actually does. So stock is trading at $1,000 and they do a 10 for 1, then you'll have 10 shares at $100 instead of 1 share at 1,000. Pretty basic math. Sometimes it could get a little bit more complicated, where it's 20 to 1 or, things like that. But usually they use nice round numbers so that it's not too confusing for people to be able to figure out what's going on. Okay, so here's a couple of examples as far as what they're purporting as, reasons behind why stock splits are a good thing. Big rallies, that's kind of what the previous article was talking about a little bit in some of those different points. So I guess, here's an example. Tesla jumped 8%, which added $84 billion to their price, to their market value. And, things like Amazon going up 5% after they did a 20 for 1. Again, I'm not going to say that doesn't happen. I will say that the idea of a company being worth a lot more just because the stock is more affordable, it doesn't seem like something that's going to be a long-term solution. So it'd be interesting to see just how much Tesla or Amazon were able to hold on to after they went through with those stock splits, to see exactly, what were the long-term implications. I think that'd be kind of interesting to look at. Go look at this next one. So this is by marketrealist.com, and it's talking about some of the different ways that stock splits might be good or bad. It says that they're good for investors. Existing shareholders receive additional shares without incurring an extra cost. However, this doesn't mean that the value of your holdings has increased. A stock split is especially beneficial for retail investors who can buy a larger number of shares in blue chip firms, which would have been expensive. I think probably the best example of something like this, it would be if Berkshire Hathaway, if they were to ever announce a stock split of their Class A shares. They're kind of well known for having really expensive stock, and if they were to ever do a stock split, it'd be kind of interesting to see what happened, because they're fairly notorious for making sure that their Class A shares retain their value, which is kind of interesting. Why they're bad? They decrease the value of a single stock. So this kind of reads like a horoscope. They're good because they decrease the value, but they're bad because they decrease the value. Which, and again, it's not that they're decreasing the value, it's just making it so that it's cut into smaller pieces. You're taking the pie. If you're going to have 10 slices of pie and then you cut each one in half, you have 20 slices of pie. It's the same pie. That's basically what's going on here. But decreased the value of a single stock makes it easier for retail investors to buy the stock. A stock split may increase the stock's overall volatility because the shares will be easier to trade. Also, a stock split may lead to risks if the stock price falls too much after the split. So this does a good job tying back into that first article. I think this is a much better example of some of the real drawbacks that you might end up with. I kind of alluded to it a little bit with that other example where Tesla and Amazon, they had, a huge jump, and, there's an equally likely case that if a company were to announce doing either a forward or a reverse stock split, that you could end up with just as much of a loss, an 8% or a 5% loss in the daily value. And that's where it's important to make sure that, if something like this happens, we kind of take a step back, don't have kind of a gut reaction and say, oh my goodness, the stock value, it's dropping, we need to sell our position, and we just need to, think about, why did we have the stock in the first place? If we plan on, having it because we think it's a good investment or we want to be saving for retirement, trying to get out of the market the day after a big move happens, probably not the best idea. I think, I've read somewhere something in line with some of the biggest trading days in terms of value gained came relatively close to when a lot of different companies lost a lot of value. So trying to trade just based off of volatility, it's a losing game. That's why we try to keep sort of a long-term mentality about our positions and what we're trying to accomplish with them. So I hope this has been helpful for you. I know it's been helpful for me going through this, and I look forward to seeing you guys in the next video. See ya. All right, so what do you guys think? Are stock splits a good thing, or are they a bad thing? I guess kind of depends on what's going on with the stock, why they're doing what they're doing, and ultimately, what's going to be best for the company overall. Do you think having people who don't already have access to the stock would make it a stronger position? Work out better for it? Or do you think having more people have access to purchasing the stocks wouldn't be such a good idea? Let me know in the comments. One thing that we didn't really touch on, so one thing that's kind of come up in recent times, this wasn't such a big deal, back when people were trading physical certificates showing the ownership of the stock, but nowadays we have things called fractional shares. They didn't have those back then. And what you can do with fractional shares, you can actually own part of a share without having it to have a split. So I think it's kind of interesting that, when you take a look at it, you don't necessarily have to wait for a stock split to be a retail investor and get a position in a big stock. I know I've purchased fractional shares of different things because it's available, and again, just kind of gotta take a look and see what's out there and what makes the most sense. So thanks for tuning in. I appreciate it, and I'll see you guys in the next video. Bye.